What is up, guys? Welcome back to my channel. My name is David Hanlon, aka the Laptop Legend, and in this video today, I want to talk about something that is extremely important if you are trading a lot, and it's called the short sellers restriction or the alternative uptick rule. This probably means nothing to most of you guys, but it's super important because it has a great impact on when short sellers are allowed to short sell stocks. And if you can understand the psychology of a short seller, it will greatly increase your profitability because it will prevent you from putting yourself in situations where a short seller is likely to be getting short. It can help you take advantage of squeezes when short sellers are squeezed out of their positions, which drives the price up. And ultimately, it's just a valuable tool to have and understand in your tool belt if you want to trade stocks at all. So it's super important. And also on top of that, it's honestly pretty intriguing. So because of that, I decided to make a video on it today. Hopefully you find it helpful. If you do, please smash that like button down below, subscribe if you haven't already, and turn on post notifications. I'll see you guys on the other side. All right, guys, so the first thing that I want to talk about is when the rule goes into effect. Then I want to talk about what the rule actually is and what implications it has for short sellers. And then I want to talk about how you can use it and read it and understand what effect it has and use that to take advantage of the short sellers in the position that they're being put in because potentially it can cause a squeeze. So I'm gonna go to my whiteboard. This is it's a little embarrassing, honestly. I am no Pablo Picasso. I am David, not Picasso. So this is my chart. This is just a little graph to help explain for you guys. Call it ticker DAV, David stock. And you can see on Wednesday, it went from around 880 and it had a nice day. It went and closed right here at $10 exactly. And that was the final print before 4 p.m. Eastern time. And that is the closing price. So even if there's trading in after hours, I think it goes for another 4 hours up to 8 p.m. Eastern time. I could be wrong on that, so, do your research, obviously, but that is my understanding of it, and the closing price is what affects the 10% drop. So let me get to that in a second. But basically, if at any point in any day of a stock trading, it falls more than 10% from the previous day's close, the rule goes into effect. So you can see here, it closed at $10, even though it went all the way up to $12 here and dropped back down to 10, 12 to 10 is more than a 20%, more than a 10% drop. It doesn't drop 10% from the previous day's closing price. So there's nothing triggered here. And it's not triggered until it breaks under this $9 mark. Because again, that is 10% under where it closed yesterday, which was $10. And again, if it traded up, closed, I guess not closed, but it went as high as $11 in after hours, I do not believe that that would affect this rule. Do your own research, obviously, but this is my understanding of the rule. So you can see here, it would only be triggered at this point, and then it would stay in effect for the rest of this day, so the rest of Thursday, and then all of Friday. So it takes place the rest of that day, and then all of the next day. So now that's when the rule actually goes into play. But what actually is the rule? Once it goes into effect, what does that mean? Well, here you can see, this is the bid, and this is the ask. So this is what the best price that someone is willing to pay for the stock. Someone is willing to pay $3.35 right now for this stock. That is the highest price that any person is willing to pay. The highest price that the lowest price that anyone is willing to sell it for is $3.44. So you can see there's quite a difference between there. That is called the spread, and this is 9 cents. So there's a 9-cent spread on this stock. And this is when this starts to come into play. So once the rule is in play, once the rule has been triggered, SSR, short selling restriction, it means that short sellers are not allowed to short sell on the bid. So they can't meet a buyer who is willing to buy at that price. So they can't short sell their shares directly to that buyer who's willing to buy at that $3.35 price. What they have to do is they have to put their short sell on the ask. So they could short sell at $3.44, but it does not instantly execute because they have to wait for a buyer to come up and meet them, which is a big difference because if short selling restriction is not enabled, they can just short as many shares as they want and drive the price down. So they can short right on the bid. They can take the guy off of $3.35, sell every single one of the shares that he's willing to buy. Suddenly the next best price that someone's willing to pay is $3.32. They can sell all their shares that he's willing to buy. Suddenly the next best price is $3.30. And they can keep doing this and keep doing this if short selling restriction is not enabled. So they can have a pretty negative impact, and that's how you can see some pretty fast drops in price. Now, if the stock, again, is in short seller restriction, they have to sell on the ask. They're not allowed to sell on the bid. So again, they can't meet a buyer. They have to be a seller and wait for a buyer to come up to them. So they can effectively, if they have enough shares, prevent the price from going any higher, but they can't drive it lower. Only people who already have shares, who have bought them and are wanting to sell them, are able to do that. So this can have a big impact, because if a stock is up a ton and comes back down and then goes under short seller restriction, it can prevent short sellers from driving the price lower, and it can be very, very hard for them to get an entry, especially if it's tanking really fast. Because I have an example here. Let me pull it up for you. VDRM. So here you can see, this is a stock that went absolutely insane. This stock went berserk. It went up 1,500% in one day. You can see, I mean, it just went absolutely crazy. This is one day, and this is what happened right towards close, man. So closed here at 295-ish, and I just put an estimate, of approximately 10% under that, 265, whatever, just so you can see on the next day. So it wasn't triggered until it dropped below this level, because the close was right here, and it has to fall more than 10% below that previous day's close. But for example, let's just say here it opened and it tanked all the way down here. Let's just say that happened, right? So say short seller restriction is now enabled on this stock. That means that when it starts spiking, and short sellers want to get in, because the more a stock spikes, the more short sellers want to get in, because they think, oh, this stock is trash, man. Look how high it's up. It's up from 0.0019 all the way up to 6 cents, 7 cents. Come on, man. This is coming down. I got to short this thing. There's going to be a huge drop. And I mean, normally they're right. But what happens is they have to be early if short selling restriction is enabled, because they want to get an entry. They want to make sure that they get executed. So they're going to end up shorting on the ask. They're going to put that sell offer above. Remember, trading is literally just a seller here and a buyer here. If there's more sellers than buyers, the price goes down. If there's more buyers than sellers, the price goes up. So as the stock is going up, if short seller restriction is enabled, they have to short on the ask. And every time the stock keeps going higher, they get more and more negative. But they keep shorting on the ask because they know when the panic comes, they're not going to be able to get executed at all, because all the buyers are going to be selling their shares on the bid, and nobody is going to be buying on the ask. Why would you buy on the ask if you could get a better price by buying on the bid, if that makes sense? So again, if you were going to buy 100 shares of PIXY and you wanted to buy 100 shares, you could buy it at $3.35. If people are selling, you're instantly going to get executed. Or you could buy it at $3.44 and pay another $9. Obviously, that's not that much of a big deal when you only have 100 shares. But if you have 10,000 shares, like, that really starts to add up. That's $900. So in that case, if you're buying, you're only going to be buying on the bid. You're not going to be buying on the ask once it starts tanking. And there's a ton of sellers who are selling right on the bid, which makes it really, really difficult for short sellers to get a fill on their short position that they're looking to get once the stock starts tanking, which means that they end up taking these short positions early to make sure that they get a fill. And they might underestimate how high a stock can go, which means that they get in really early, and they might be in up to their neck. They might be negative 100% on their position. Because remember, shorts, there's no limit to the amount of money you can lose. If you buy something, the worst that can happen is it goes to zero, you lose 100% of your money. But if you short something at 3 cents and it goes all the way up to 6 cents, you lost 100% of your money. But if it goes all the way up to 9 cents, you lost 200% of your money. That's insane. So this is why that happens. There's short sellers who are shorting right here at 4 cents, and this goes all the way up to 6.50, and they're thinking, oh my God, it breaks 7. They're like, all right, I got to get out. I'm already 100% negative. I don't know how high this thing's going to go. So then they buy back in, and that pushes the price even higher. So when it finally tanks, you can see this first red candle here. It drops a lot really, really quickly. Why is that? Because there's so many momentum buyers who got in here who were like, shoot, that was the top. I need to get out quickly before it goes past my entry. So they sell their positions, but they do that on the bid, which pushes the price down really far. And again, when they're selling on the bid, nobody is going to be buying on the ask. If you can get executed as a buyer, you want to do it on the bid if possible because you will get a better entry. Which means that once it starts tanking, it's too late for short sellers to get in usually until there's some type of bounce. If short seller restriction is enabled, which makes it super, super difficult. And it's just, you have to understand this psychology because that is why short sellers will get in early on these insane rises because they want to make sure that they get executed because, I mean, this thing is already so overextended. I mean, that's right here. If we're talking about, if we go back to the 1 minute candles, getting in right here is the equivalent of getting in right here. Look how big this already is up. So they're thinking if I get in here, man, I could get in at 4 cents and I could buy back at 1 cent. That's a huge gain. What is that, 75% gain? That's insane, man. That's incredible if you're short. You'll take that any day of the week. So like, they want to get in early and make sure that they get that. But then it keeps squeezing. And by the time that it turns, it's too late for them to get executed and they can't get in until a bounce. So that's why you need to be careful of that. But you also need to keep into consideration that when there are these bounces, there's going to be a lot of shorts on the bounce. If it's a bounce that's coming after a massive panic, there's going to be people who are looking to get short on those bounces. So once these bounces turn, you better get out, man, because they almost always go under where they were before, under the previous low from the first tank. And normally these bounces come because there's short sellers who timed it better than the ones here. They might have shorted right at the top. They short at 7.6 and they can cover here at 5 cents. I mean, that's a good quick profit right there. So they cover their position to get out. And not everyone does that, obviously, but that's part of what makes these bounces when there's such a big drop, which is part of why I love the risk to reward of buying in right after there's a ton of really steep red candles. Because if there's shorts in that, a lot of times they'll be like, all right, I'm set with that profit, man. I'm going to buy back in to cover my short share. So that is why this is so important to understand. And typically speaking, you'll see, so a lot of times on level 2, when short seller restriction is enabled, you will see this SSR, and that will let you know that it is enabled. So keep that in mind, because once it's enabled, shorts are going to have a harder time getting their shorts when they want them. So if a stock starts squeezing and short seller restriction is enabled, it's more likely to continue to squeeze than if it's not enabled because shorts need to rush into their short position and get in when it's still going up. They can't get in once it starts turning because at that point it is too late. So anyways, guys, hopefully this video helped you. I find this concept really, really interesting, and I find that it helps me a lot in my trading, understanding how shorts think and how that can affect how you trade as a long trader. So if you found this video helpful, please smash that like button. If you made it this far, I'm not gonna give you a kiss this time because too many of you guys liked that last time. That was a little creepy. So maybe sometime in the future, but don't tell anyone. But yeah, I'll see you guys in the next one. Until then, you know the drill. Let's grow better together. Preguntar, bebé, dime por qué te mientes. No puedes esconder todo lo que tú por mí sientes.